Maria, very good morning to you. So what are the details of this? We heard the G7 talking about this. The OECD has pushed around various versions of this over the years. So what are the details of what's been agreed?
Yes, Hannah, and if you look at the announcement made yesterday by the OECD, they promise what is a tax revolution for the 21st century. Now, we're looking at a new tax framework for international business that is based on two new pillars. The first one would be, of course, that effective rate of at least 15% for companies operating on a global scale. The second one, and perhaps even more important for European countries, is the reallocation of tax rates to the country and the jurisdiction where the services are made and provided. You know, a lot of the European countries had complained over the past years of big American tech that operates in Europe. They would shift profits to low tax jurisdictions, and that was preventing them from taxing them the right amount of money in the countries where they're benefiting from providing services and, of course, where they make money. So this would open the door to that. Now, as you said, Anna, this is an OECD agreement. We're looking at 130 countries out of 139 countries that are members of the organization agreeing to this, and it does pave the way for a G20 deal next week in Venice. But of course, remains to be seen whether or not they manage to get consensus.
So that's where things move next week, but they haven't managed to get everybody to sign this. There are some holdouts, and some of those here in Europe.
Yes, you know, we're looking at 9 countries yesterday who said they're not in a position to agree to this OECD paper. One of them, of course, being the Irish government. They put out a statement yesterday, Anna, in which they said we can work with the reallocation of tax revenue to the market jurisdiction. We could do that, but we cannot commit to that at least 15% minimum corporate tax rate. Now, Anna, there's 2 reasons for this. One, of course, is that the Irish economy has benefited from that low tax jurisdiction. They do have a competitive edge on that front. And also in terms of the wording, that at least, it does mean that the effective tax rate could go beyond 15%. And in fact, Anna, we know that countries like the French would like that 15 to just be the starting point. They would want to take it higher. So the gap between the effective tax rate in the Irish economy and the potential tax rate could be even bigger than 15% going forward. And for the Irish, that is problematic.
Right. So mindful perhaps of international business, but also domestic Irish business and the tax burden there. Maria, thanks very much.